You know when you're scrolling online and you come across one of those super high energy, almost frantic videos about the economy? They can be pretty confusing, right? Well, today, we're going to hit pause on all that hype. We're going to take one of those clips and break it down piece by piece to figure out what's really being said.
And of course, it always kicks off with something like this, a hook designed to make you slam on the brakes and pay attention. The whole idea is that some massive secret has been revealed and you're about to get the inside scoop. Okay, let's bite. What on earth is going on here?
All right, first things first. We have to cut through all the noise and the alarm bells and get right to the data. What is the one piece of information that's causing this whole firestorm?
And there it is. This entire freak out, all this talk about U-turns and market shocks, it all comes down to one single really important piece of economic data, the monthly jobs report. And the big claim here is that it was leaked before it was even officially released.
Now, before these reports officially drop, you've got all the experts and analysts on Wall Street making their best guess. This number? This was the forecast. The market was basically expecting the economy to have added around 55,000 jobs in February. So that was the line in the sand. That was the benchmark.
And then, bam, this is the number that supposedly gets out. A loss of 92,000 jobs. I mean, the gap between what was expected and what reportedly happened is just massive. We're not talking about a little miss here. This is, like the clip said, a total collapse of the forecast.
And wow, this chart really just lays it all out for you, doesn't it? You can see where we were the month before, healthy job growth. You see the pretty tame, positive number everyone was predicting, and then you just see this absolute nosedive into the red. As a picture, it tells a really powerful story of expectations getting completely blown out of the water.
Okay, so job losses. That sounds bad, period, right? I mean, it's bad for people, bad for the economy, but in the kind of weird upside-down world of finance, it's not always so black and white. And that brings us to the absolute core of this whole thing, the paradox that bad news can actually be great news for investors.
So here's the million-dollar question. How can a report that screams economic weakness possibly be seen as rocket fuel for your portfolio? It feels like it makes no sense at all, but believe me, there is a very specific logic at play here. And this is the chain reaction laid out perfectly. It all starts with that weak jobs report. That's step one. Now, that weak number signals to everyone, especially the Federal Reserve, that the economy is starting to cool off. So the Fed sees that and thinks, okay, our fight against inflation is probably working. That makes it way more likely they'll start cutting interest rates. And that, my friends, that's the rocket fuel. Lower interest rates make borrowing money cheaper for companies, which helps them grow, and that can send things like stock prices way up. Okay, so that's the logic. But how do people actually turn that logic into action? To get that, we need to speak the language, we need to understand the trading vocabulary that was in the clip's call to action. Right, so the video asks if you're a bull or a bear. This is classic market shorthand. Think of it this way. A bull is optimistic. They think the market is going to charge forward and go up. A bear is pessimistic. They think the market's going to swipe down and fall. So really, the question is just asking, based on this news, are you feeling optimistic or pessimistic about where the market is headed? Then the clip asks if you're buying the dip. This is a classic bull move. The idea is that this bad news about jobs might cause prices to drop for a little while. That's the dip. A bull doesn't see that as a disaster. They see it as a sale. It's a chance to buy in cheap, betting that the rocket fuel from those potential rate cuts is about to kick in and send prices flying again. And the clip even points you to exactly where this action might happen: Bitcoin and SPY. Now, if you're not familiar, SPY is just a super common way to invest in the 500 biggest companies in the US all at once. Both of these are seen as being really sensitive to what's going on with interest rates, which is exactly why they're being highlighted here. So, let's just zoom out for a second. We took this frantic, high-energy clip and we just completely deconstructed it. We went from that initial shock value number to the totally counterintuitive, bad news is good news logic, and then finally to the actual trading lingo being used. Look, the point isn't to agree or disagree with the take. It's to actually understand the system behind the hype. And that really just leaves us with one last question for you to think about. Now that you see the step-by-step logic, how does it feel to you? Does a weak jobs report now look like a clear financial opportunity, or does it still feel more like a big red warning sign for the economy as a whole? That's the exact tension that investors are dealing with every single day.